Right now, millions of people think they're being incredibly responsible. They sold their stocks, skipped crypto, avoided real estate, and parked everything in a 5% cash account. They think they're finally safe. But as Sir John Templeton famously warned, the 4 most dangerous words in investing are, "This time it's different." But there's one big problem. Inflation is basically a silent raccoon stealing fries out of your pocket while making direct eye contact. You won't notice it immediately, but 5 years later, your safe money buys way less stuff. And here's the terrifying part no one is talking about. The world right now is stuck in something economists hate: sticky inflation. Not explosive inflation, not hyperinflation, but sticky inflation. The kind that refuses to die, like glitter after a kindergarten art project. We've actually seen this movie before. In the 1970s, America printed huge amounts of money. Oil shocks hit the economy. Government spending exploded, and inflation went absolutely feral. In 1974, US inflation crossed 12%. By 1980, it hit nearly 14.8%. And regular people got trapped because they thought cash was safe, but inflation was melting purchasing power in real time. If you earned 5% in a savings account, but inflation was 10%, you were actually losing 5% every year. That's the trap. People confuse nominal returns with real returns. Your bank account number goes up, but your actual wealth goes down. It's like getting a raise while your landlord turns into a supervillain. And today, we're dangerously close to a modern version of that environment. Not identical, but rhyming. Because history doesn't repeat. It remasters itself with better graphics. Look at how fast those graphics remastered themselves. We saw the setup in 24 and 25, and now in 2026, the cracks are wide open.
Let's talk numbers. In 2020, governments and central banks flooded the system with money. The US money supply exploded by roughly 40% in just 2 years. That's historic. Then inflation hit hard. In June 2022, US CPI inflation peaked at 9.1%, which was the highest in over 40 years. The central bank responded aggressively. Interest rates went from near 0% to over 5%. Fastest hiking cycle in decades. And now everyone thinks, cool, inflation has been solved. Except it may not be, because the stay parts of inflation are still hanging around. Shelter costs, insurance, healthcare, services, wages. Even after inflation cooled from 9.1%, core inflation stayed stubbornly elevated. And this is where the trap gets evil. Because cash suddenly started paying yield again. Money market funds now pay around 4 to 5%. Treasury bills too. So people feel smart holding cash. But if inflation stabilizes around 3 to 4% long term, your safe return is barely real growth after taxes. And if inflation spikes again, you're back underwater. Quietly. Slowly. Like a frog in boiling water with a finance app.
Here's the problem. Nothing feels safe anymore. Stocks? The market is heavily concentrated again. The top tech giants now make up roughly 1/3 of major US stock index value. That concentration starts looking suspiciously like the Nifty 50 era of the early 1970s. Back then, investors believed a handful of elite companies could never fail. Then, reality arrived with a steel chair. Some stocks fell 60 to 80%. Even great companies got crushed because valuations got insane. Sound familiar? Today, AI optimism is doing the same thing. Investors are treating certain companies like immortal gods. And maybe some will dominate, but expectations are now enormous. Meanwhile, bonds got wrecked during the rate hikes. Real estate is squeezed by high mortgage rates. Commercial real estate looks like a zombie apocalypse in some cities. Crypto is volatile enough to raise your blood pressure through Wi-Fi. And cash? Cash slowly decays if inflation stays sticky. That's the real crisis. Not that one asset is doomed. It's that every asset now has trade-offs. The easy money era is over. Now investors actually have to think again. Terrifying concept.
Here's the uncomfortable truth nobody is talking about. Cash is not safe. Neither is chasing hype. The real danger isn't volatility. It's losing purchasing power while believing you're protected. That's what inflation does. It punishes complacency. Silently. Over time. And history shows something important. The people who survive these periods aren't the ones making all-or-nothing bets. They diversify, manage risk, stay liquid, own productive assets, and most importantly, they think independently when everyone else joins a financial cult. Because in markets, there is no perfect safety, only trade-offs. And the moment everyone believes something is completely safe, that's usually when the danger begins. If this video made you question what safe really means, good. Because the next decade of investing won't reward people who follow headlines. It'll reward people who understand the game beneath the game. So if you want sharp macro breakdowns, market psychology, financial history, and brutal lessons Wall Street only learns after crashes, hit subscribe. Because while everyone else is chasing hype, we're trying to survive reality. But before you go, leave you with one final rule of thumb to survive the 2026 cash trap. It's called the Rule of 72, and it's the easiest way to test if your money is actually dying. Take the number 72 and divide it by the real inflation rate. If core inflation stays sticky around 3.6%, that means the purchasing power of your cash cuts exactly in half every 20 years. But if it ticks up to just 6%, your wealth gets chopped in half in a mere 12 years. When you look at your savings account balance today, don't just ask what it's worth now. Ask what it buys a decade from now. The system wants you to stay complacent because quiet inflation is the ultimate invisible tax. Don't let them collect it from you.